A financial bomb just started ticking in Washington, and this time, the detonation isn't coming from Beijing's military or cyber arsenal. It's coming from the bond market. In just 72 hours, Treasury yields surged past 4.5%. Foreign buyers pulled out of auctions and panic rippled through trading desks from Wall Street to Singapore. Then, without warning, the White House reversed course on China tariffs. No press conference, no negotiation, just a silent rollback that reeked of desperation. Why? Because Beijing was rumored to be preparing something far more destabilizing than sanctions, a full-scale treasury dump. And if you think that's just speculation, the cracks have already started to show. The White House's tariff rollback on April 9th wasn't gradual. It was abrupt. Electronics machinery and even EV components were quietly removed from the tariff list. Officially, it was framed as a move to shield American families from inflation. But behind the scenes, multiple sources told Bloomberg the real pressure came from a 28% drop in foreign participation at a Treasury auction just days prior. The yield on the 10-year had shot to 4.5%, dangerously close to the 5% threshold that triggered last year's regional banking stress. Treasury Secretary Scott Bessent reportedly convened an emergency call with Beijing's diplomatic team, unusual protocol that coincided with the tariff reversal. According to J.P. Morgan's bond strategist Phoebe White, the administration lost control of the bond narrative, and when Treasury's panic policy follows, the public saw a press release. The bond market saw a white flag. While China is the focus of Washington's anxiety, Japan moved first and more aggressively. In February 2025 alone, Tokyo dumped $36.6 billion in treasuries, its largest single-month sale in over a decade, according to the Treasury International Capital TIC report. This wasn't ideological, it was defensive, with the Bank of Japan abandoning yield curve-controlled Japanese institutions sold U.S. debt to stabilize domestic bond markets and defend the yen. But the implications are broader. If a U.S. ally is selling treasuries in bulk, how should markets interpret the silence from China? As of March, China's holdings stood at $775 billion, down over 30% since 2018. And while Beijing hasn't launched a sell-off yet, it doesn't need to. As Barclays' Ajay Rajat Yaksha puts it, China's weapon isn't the sale, it's the threat of one. The financial gun is loaded. No one's sure if she will pull the trigger, but the finger is on it. A 5% yield on the 10-year Treasury isn't just symbolic, it's structurally unsustainable. On March 27th, the yield briefly touched 4.96%, causing credit markets to seize. Mortgage rates jumped past 7.8%. Corporate debt spreads widened by 52 basis points overnight, and regional bank equities plunged by 6.2% on average, according to Goldman Sachs's Financial Conditions Index. The deeper problem is debt servicing. With over $36.2 trillion in federal debt, each percentage point in yield adds roughly $346 billion in annual interest expense. The Congressional Budget Office now projects interest on debt will exceed defense spending by mid-2025. And in Q1, debt servicing alone cost $273 billion more than all Medicaid outlays combined. According to the Wall Street Journal, traders at BlackRock warned institutional clients that if yields break 5%, the Fed may be forced into unscheduled intervention. In that context, the tariff retreat wasn't just political, it was survival. As the bond market convulsed, the Federal Reserve faced an impossible dilemma: defend the dollar or rescue liquidity. If it tightens, yields spike further. If it eases, the dollar weakens and inflation risks reignite. The Fed's balance sheet, already bloated at $7.4 trillion, has little room to maneuver. In the first quarter alone, the Fed booked an operational loss of $142 billion due to interest payments exceeding its income from assets, according to its own March report. If another systemic crisis unfolds, emergency liquidity injections may require a full balance sheet expansion, precisely as Congress debates deficit caps and fiscal ceilings. Former Treasury official Stephen Ratner told Bloomberg the Fed is now backstopping both the banking sector and the U.S. government. That's not monetary policy, it's triage. The question is no longer whether the Fed can act. It's whether markets will still trust it when it does. Capital doesn't wait for permission. In the first quarter of 2025, German bond inflows hit 76 billion euros, up 41% year over year, making them the top-performing sovereign asset by foreign demand, according to data from the European Central Bank. The driver isn't yield, it's credibility. With the U.S. trapped in political gridlock and Japan defending its own currency, Eurozone bonds, particularly Germany's, now represent stability. The dollar index has dropped 3.8% since January, and central banks from Brazil to the UAE are increasing euro and yuan reserves while trimming dollar holdings. In March, the IMF reported that global dollar reserves fell to 57.1% of allocated reserves, the lowest in nearly 30 years. HSBC's global macro strategist Max Kettner stated, "The dollar is no longer the automatic safe haven in crisis. It's now a volatility amplifier." And with China pushing alternative systems like SIPs and digital yuan settlements, the global financial ecosystem is beginning to unbundle from dollar dominance one trade at a time. When the White House reversed key tariffs in April, Apple's exemptions weren't just strategic, they were symptomatic. While hundreds of U.S. firms scrambled to adjust sourcing, Apple quietly secured a waiver for Chinese-made display modules and semiconductor packaging components central to its iPhone 17 launch cycle. According to a Bloomberg analysis, Apple sources over 60% of its global assembly through China, and nearly 95% of its critical silicon packaging is still routed through Jiangsu and Guangdong. Tim Cook's February visit to Beijing wasn't ceremonial, it was transactional. Insiders at Caixin report he offered Apple's logistical footprint as leverage, warning U.S. policymakers that a full decoupling would cost the company up to $21 billion in relocation and delay its entire 2025 product line. Analyst Ming-Chi Kuo emphasized Apple's dependency on Chinese tech is not just deep, it's embedded into their physical infrastructure. Exempting Apple wasn't a favor, it was an admission. Some American icons are too entangled to unplug. Strip away the slogans, and you're left with this. The average U.S. household is financially brittle. According to the Federal Reserve's March 2025 data, 37% of Americans cannot cover a $400 emergency expense without borrowing or selling assets. When tariffs on Chinese imports were increased during 2018-2019, the Tax Foundation estimated a net cost of $831 per year to U.S. consumers. But that was before inflation. In 2024 alone, real wages shrank 1.3%, while the Consumer Price Index rose 3.7%, a double hit that erased most pandemic-era savings cushions. Now factor in the new USTR estimates. If reinstated, full tariffs on consumer electronics, textiles, and automotive parts would raise prices on those categories by an average of 12.4%. Bankrate's 2025 report shows that 61% of consumers are already reducing discretionary spending due to cost pressures. Trade wars may target China, but they hit American wallets first. And this time, there's less room to absorb the blow. Internal coherence is no longer evident in U.S. trade policy. In the span of 6 weeks, the administration floated new tariffs on Chinese EVs, rolled back existing levies on industrial components, and then publicly criticized Apple's reliance on China, the same company it just exempted. A leaked Commerce Department memo, reviewed by Reuters on March 29th, revealed internal conflict over strategic coherence and sequencing of tariff policy. One faction, led by senior USTR officials, advocates aggressive tech decoupling. Another, supported by Treasury and Fed advisors, warns that escalation will destabilize markets already pricing in fiscal strain and geopolitical uncertainty. The disjointed moves are being interpreted not as chess, but as whiplash. Economist Eswar Prasad of Cornell noted tariffs have become reactive levers, not part of a coordinated strategy. That perception matters. When policy looks improvised, markets lose confidence, and so do allies negotiating trade alignments of their own. The political calculus is brutal. Trump's approval among independent voters fell to 39% in the April YouGov poll, the lowest since his return to office. At the same time, the Conference Board's leading economic index fell for the 14th consecutive month, suggesting a recession probability above 50% in the second half of 2025. Goldman Sachs downgraded U.S. GDP growth forecast to just 1.2% for Q3, citing trade instability and deteriorating business investment. Key industrial states, Wisconsin, Pennsylvania, Michigan, are already seeing auto layoffs tied to raw material cost surges after tariff threats. Trump's 2024 campaign thrived on economic strength narratives. But if tariffs drag the economy into contraction, the electoral backlash could mirror 2008's political realignment. Sources close to the administration told the Wall Street Journal that further rollbacks are being discussed, but timing them without appearing weak is the core dilemma. So, the question isn't whether Trump blinks again, it's whether markets will wait that long. Washington can soften tariffs. It can stall Treasury auctions. It can even pressure the Fed. But it can't stop what's already moving underground: China's exit from the dollar system. Because while DC plays defense, Beijing is wiring a new financial architecture through energy trade, commodity settlements, and state-backed digital rails. So if you think this reversal was the climax of U.S. China economic warfare, you might be missing the real battlefield. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.